and prosperity.
Welcome back. Let's get a corporate conversation going. It's a weak set of earnings from Motherson Sumi Wiring. The margins have come under pressure despite a 16% year-on-year growth in the top line. So margins have fallen by nearly 350 to 400 basis points. The CFO of the company, Gauba, is now with us on the show now. Afternoon, and thanks so much for joining in. First, if you could explain what led to the margin drop on a quarter-on-quarter basis, what were the line items? And secondly, what is the outlook on margins in Q4? Does it stay at these current levels of 10.5%, or do you foresee an improvement or a decline?
Good afternoon. Thanks a lot for getting us on the CNBC. First of all, I think what is important is this is the year in which we have just bifurcated, but at the same time, the market has undergone a significant amount of change. You have seen a lot of new models coming, a lot of new products coming. So we got 11 new programs, either which were a full model changeover or a new programs altogether, which we have developed so far in these 9 months. In addition, of course, there have been few facelift. What it really meant that we needed to add capacity, both in terms of number of factories. We added 3 more factories, as well as added about 7,000 people, because as you are aware, wiring harness is a people's job where you need to get the people up front, train them, so that the launch by the OEMs is very, very successful. So it is to be seen that as a work in progress, wherein we have built capacity for the new models which are coming. Quarter 3, as the life has been traditionally weak because of less number of working days, and on the top there was a chip shortage challenge faced by some of the OEMs. We are very confident, we are very optimistic given the strong demand. As the supply chain becomes more and more stable, these capacity utilization will get only better. And therefore, you see that reflected in the better profitability.
Mr. Gauba, some reference, numbers perhaps would help a little bit. By when do you see margins, say, get back towards the 13 to 14 mark? Is it going to take a couple of quarters, or do you see a quicker recovery than that?
First of all, as you know, as a group, we don't guide on margins. We work on return on capital employed with a group target of 40%, because the margins may not truly reflect the true profitability, given that when we start with the new products, it may start with a higher import content or just the plug-in of certain high-value parts. So therefore, we would like to see more and more localization in times to come. But at the same time, by Q1 of FY 23-24, we do see that the profitability will be better, as you have been seeing in the past, similar to those levels.
Okay. What's the current capacity utilization?
See, in terms of the newer plants, the capacity utilization could be somewhere in the range of 30 to 40% as yet. As we have said, we have increased our capacity by 25%, whereas the revenues would have gone up only by 15%. So the capacity utilization of the newer plant is much lower. As we also are developing new products, we will continue to focus on adding new capacity ahead of the time.
All right, so thank you very much. Appreciate you joining in with that perspective. Thanks indeed, and good luck. Well, with the Paytm